It's Wednesday, the 17th of March 2021, St. Patrick's Day. Welcome to Fear and Greed, the business podcast that sets you up for a successful day. I'm Sean Aylmer. The federal government goes into battle over industrial relations as the number of disputes hits decade lows. That's our main story. Also coming up in today's podcast, British Prime Minister Boris Johnson looks to Asia for the future of the UK. Debt levels for homeowners surge as property prices jump, and the story of the top 200 stock that's up 800% over the past year and is not Afterpay. Later in the podcast, I talk to Albert Kwok, Emerging Markets Portfolio Manager at Jennison Associates. But first, here's a brief look at markets. The Dow Jones Industrial Average fell from its record highs overnight, while the Nasdaq briefly touched a new fortnight high, while the S&P 500 was broadly unchanged. Investors seem a little stuck at the moment as to whether to continue to buy cyclical stocks, those that do well when the economy's picking up. Markets are waiting on what the US Federal Reserve says later this week, particularly about the sell-off in bond markets. The Fed so far has insisted that it wasn't worried about inflation and there's no problem in the world's largest economy, but many investors disagree. If the Fed even hints that it's concerned, then cyclical stocks are likely to outperform. European markets were stronger, with the Stoxx Europe 600 up almost 1%. The Australian share market ended yesterday pretty strongly, with the S&P ASX 200 rising 0.8% to close at 6,827 points. Some of the poorer performers in recent weeks did best, including tech stocks, healthcare companies and real estate trusts. Oil prices fell overnight, as did gold prices, and the Aussie dollar is trading at 77.5 US cents. Bitcoin went up, and now, over the past 24 hours, it's gone down. In fact, over the past 2 days, the value of the digital currency has dropped 12% from its peak of more than $61,000 per unit. The tumble came after media reports said that India was going to criminalise possession, issuance, mining, trading and transferring of cryptocurrencies. And iron ore prices have suffered, down from their 10-year high of $178 a tonne earlier this month to around $168 a tonne. Mind you, that's still pretty high. The fall coincides with increased expectations about China making an announcement about reducing its global emissions, potentially by clearing up its huge steel-making industry and reducing excess capacity. Iron ore, of course, is the raw ingredient for steel making. The federal government's Omnibus Industrial Relations Bill is set to go to a vote tomorrow, a vote which Scott Morrison has significant political capital tied up in. Since May 2020, the federal government has undertaken working groups with employers, industry groups and unions to discuss reforms ranging from a new definition of a casual employee, larger penalties on employers who underpay workers, and greater flexibility under modern awards. The bill also seeks to prevent employers from being liable to billions of dollars of back pay after recent court decisions, which said casual workers were entitled to paid leave. The government is now trying to get the bill through the Senate and needs the support of the two One Nation votes and the Centre Alliance vote. Two other crossbenchers, Rex Patrick and Jackie Lambie, have already said they want a delay in any vote. One Nation's Pauline Hanson and Malcolm Roberts want changes that allow casuals to seek permanent employment after just 6 months of regular work, not 12 months. And Centre Alliance's Senator Sterling Griff wants the bill to give casual workers access to arbitration by the Fair Work Commission when a casual employee is denied a request by the employer to become permanent. It comes at a very crucial time in the economy, with JobKeeper payments ending this month, and for the government, the bill's architect, Attorney General Christian Porter, is currently on leave. Ironically, it also comes at a time when industrial disputation is at decade-long lows, albeit the legislation's about much more than reducing the number of stop works. Disputation in Australia has been low for more than a year, new Bureau of Statistics figures show. In the December quarter last year, just 32 disputes occurred, involving 2,600 employees and 16,500 working days lost. That was actually a busy quarter relative to the rest of the COVID-hit 2020. In fact, during 2020, there were almost half the number of disputes and working days lost as the year before, according to the Bureau. If you look at longer-term trends, there were 3 times the number of disputes in late 2016 as there was last December quarter. And a decade ago, it wasn't uncommon for there to be quarters where 100,000 working days were lost, compared to less than 20,000 per quarter over the past couple of years. The peak in disputes happened back in the late 1980s. Nowadays, most disputes are enterprise bargaining related and mostly over employment conditions. New South Wales lost most working days last quarter, and transport, postal and warehousing was the sector most affected. The PM has hung his hat on industrial relations reform. This is the bill they're trying to push through Parliament, but it's a huge bill with lots of moving parts. Scott Morrison needs to get it through in some form. Whether or not he succeeds, one of the battlegrounds in the run-up to the next federal election has been established. In a moment, the rest of the news you need to know this morning. Overseas news first up. British Prime Minister Boris Johnson wants to tilt his country's post-Brexit international policy towards the Indo-Pacific, saying it was increasingly the geopolitical centre of the world. He also wants to make climate change his number one international priority and said the UK needs to be more of a global activist. Under his blueprint for the next decade, Mr Johnson plans to boost the country's stockpile of nuclear weapons while cutting troop numbers, tanks and some fighter jets. China's President Xi Jinping has ordered regulators to step up oversight of internet companies, crack down on monopolies, promote fair competition and prevent the disorderly expansion of capital, according to the Financial Times. In other words, Beijing is cracking down on the tech companies. And Volkswagen plans to take on Tesla by selling 1 million electric or hybrid cars this year, building half a dozen battery cell plants in Europe and expanding infrastructure for electric vehicles globally. Volkswagen is the world's second largest car maker. Locally, the number of heavily indebted property buyers has surged over the past 2 years, and there's been a jump in the number of people taking out new loans who own less than 5% equity in their homes. Figures from the Australian Prudential and Regulation Authority show that during the December 2020 quarter, there was a 19% surge in loans that were considered non-performing, reflecting the bite of the pandemic. The jump in heavily indebted borrowers comes as house prices rise quickly. Despite last year's recession, record highs for median prices were set in Sydney, Brisbane, Adelaide and Hobart. It's contributed to 17% of borrowers now owing more than 6 times their annual income. That's up from a little over 14% 2 years ago. Apple remains relatively calm about the outlook, saying asset quality was stable thanks to measures providing support to borrowers. But the outlook is uncertain as those measures recede. Meanwhile, the Commonwealth Bank reported that buying intentions continued to climb last month, hitting their highest level since 2015. Minutes of the Reserve Bank's board meeting earlier this month show the bank is fully committed to maintaining record low interest rates, assuring investors it will keep its targets on benchmark 3-year bonds. The minutes explain why the bank doesn't think it will move on the official cash rate until 2024, and that's because wages growth needs to be sustainably above 3%. And that's not going to happen anytime soon, the bank forecasts. The board was worried about the end of JobKeeper in the next fortnight, saying there could be a temporary pause in the labour market, but it wouldn't be sustained. It was also calm about rising house prices as long as lending standards were maintained. In other economic news, payroll job numbers are now above their level of 12 months ago in all states, except for Victoria and Tasmania. Official labour force figures for February are due out tomorrow, and economists expect close to 30,000 new jobs. The European Union has warned Australian steel and aluminium exports will be subject to the EU's planned carbon border levy, according to the Australian newspaper. The EU ambassador to Australia, Michael Polch, told the paper that Europe would also require Australia to formally lift its ambition to cut carbon emissions if an Australian-EU trade agreement was to be reached. Health Minister Greg Hunt, along with Chief Medical Officer Professor Paul Kelly, have downplayed concerns about the AstraZeneca vaccine, despite several European countries and Indonesia suspending its use after blood irregularities developed in a very small number of recipients. Maverick Nationals MP Matt Canavan also called for a halt to the drug's rollout. The Therapeutic Goods Administration said there was no evidence of a plausible relationship between the clots and the jab. Meanwhile, Prime Minister Scott Morrison said while the original pace of the vaccine rollout was not what had been hoped for, it was starting to accelerate across the nation. Supermarket sales in Metcash's IGA stores rose more than 14% during the last 4 months, compared to a year ago. Hardware sales and liquor turnover were particularly strong, and the group said it would increase its dividend payout ratio at its half year. The group plans to spend $375 million over the next 3 years to refurbish its stores expand its e-commerce ability, and improve its prices. Metcash's share price fell 4% after the announcement. No surprises, but overseas visitor arrivals to Australia were down almost 10% in January compared to December, and were down 99% on a year earlier. Incredibly, there were still 1,580 trips from New Zealand, 890 from the USA, and 740 from Britain. PointsBet is a top 200 company that's the best performing stock over the past year. The gaming company jumped 4% yesterday, taking its annual rise to just shy of 800%. Why? PointsBet operates in the US gaming market, which until recently has been very regulated. But things are changing, and PointsBet is benefiting. Yesterday, it said it had purchased Dublin-based Benac Technology to boost its offering. And on Monday night, New York State said it was considering opening up its market to gaming providers, and that could be good for PointsBet. Its ambassador, and presumably large shareholder, is basketball great Shaquille O'Neal. The level of technology experience on Australian bank boards is poor, according to consulting group Accenture, with just 12% of all directors having technology experience. Britain's measure is 26% of directors, and in the US, it's 19%. It's a sobering finding given that pretty much everyone agrees that technology is critical to business success. Nine Entertainment and News Corp have both signed deals with Facebook about providing journalism to Facebook users via the Facebook News product. And the boss of Pendle Group, Emilio Gonzalez, will step down after 11 years in the top job. He's overseen a transformation of the company from domestic equity fund manager with $42 billion under management to a diversified global fund manager with almost $100 billion under management. The real success, though, is his ability to stay in the job for more than a decade in an industry not known for longevity. Some of the fastest growing economies are in what are known as emerging markets. These are less developed economies who are shifting from second or third world economies into first world countries. Many Asian nations fit into that category. Investors are forever wondering how to take advantage of the growth in these economies. Where should they put their money to get a good return in economies where companies and sectors are expanding much faster than many of their first world counterparts? There's no easy answer to that question, but to help us out, I'd like to welcome to Fear and Greed Albert Kwok, Emerging Markets Portfolio Manager at Jennison Associates. Morning, Albert.
Good morning, Sean.
What economies do you like at the moment? Asia is in our region. That's kind of where I'm heading towards. What sorts of things are you looking for within economies in the Asian region that you would think about then going and stock picking?
Well, first of all, we employ a bottom-up strategy, meaning that we don't start identifying the regions and the markets that we want to invest in. It all starts with the companies themselves. But in the moment, we are finding most of our opportunities in China and in India. And in each of the markets, the dynamics are quite different. For an example, in China, we focus more on the long duration disruptive technologies. Because China is actually pretty, I wouldn't say mature, but it's not your typical emerging market. The penetration of e-commerce is actually one of the highest in the world. So compared to India, they are definitely on a different level when it comes to the maturity curve. So in China, for an example, what we like is what we call the next generation internet companies. These are the new players that are actually disrupting the incumbent internet giants, and they're gaining shares. Also, healthcare is another area that we like in China. On the demand side of the equation, the Chinese population is getting older, they're getting richer, and they're getting sicker. And on the supply side of the equation, many Chinese companies are actually moving up the value chain. They're moving away from the generic drugs, and they're, developing and coming up with many new innovative drugs. So we like the demand and supply dynamics there. And also we like the supply chain localization theme. As you know, the world is turning more inward looking, unfortunately, and globalization, is pretty much a thing of the past, and localization is the new trend. But we see that there are, although this is not the optimal outcome, but there are winners and losers, and there are opportunities as a stock picker.
What about India? You mentioned India just then. What are some of the opportunities in India? Huge population.
Yes. We like India as a market. I always said that, India is one of the few true emerging markets left. It has a very young population. The savings rate is very high. And recently, we are also very encouraged by the economic reforms and the fiscal stimulus package put forth by the government. This time around, these programs are less so about consumption. They are targeting to improve productivities and efficiencies, which we think will have a much longer duration impact. We also like India as a big cyclical opportunity. As you know, they were hit pretty badly by COVID, and they're actually recovering quite quickly.
So how has COVID impacted investing in emerging markets?
It's interesting that you mentioned that because we think that COVID will not only be the worst pandemic in recent history, but it will also likely turn out to be a cleansing event that brings structural shifts to the world, actually. Life after COVID will be very different from the one before. Many trends adopted during COVID, like telework and e-commerce, will be structural and not temporary. Now that the infrastructure is laid out and behaviors would be permanently changed. We will also see more emphasis and investments on healthcare in the EM economies. So I think overall, undoubtedly, the disruptions will continue, and we think that the rebalancing of the old and new economies will only accelerate.
So is investing in emerging markets, sounds to me then, is much more of a long-term play rather than a short-term play if we're talking structural changes?
Yes, absolutely. Firstly, I think, the next 1 billion consumer will be coming from the EMs. The demand potential is just humongous. Secondly, perhaps more importantly, I think we are seeing a paradigm shift in EM equities fundamentally. EM equities in the past were always thought to be driven by, commodity cycles, fixed asset investments and exports and, liquidity flows. However, increasingly, many of the EM economies are actually moving up the value chain. We are finding more and more innovations and disruptive technologies in these economies. These new innovations and technologies are actually driving the structural changes and the productivity gains that many policy reforms fail to bring. So this paradigm shift brings a whole new set of opportunities for investors. And I think this is an exciting time for stock pickers.
Albert, thank you very much for talking to Fear and Greed.
Thank you so much, Sean, for having me.
That was Albert Kwok, Emerging Markets Portfolio Manager at Jennison Associates. There's more to my conversation with Albert, and you'll find the full interview in the Fear and Greed playlist. He talks about why many of the opportunities in emerging economies are actually outside of the stock market in those countries. He also explains why you can't be a passive investor if you're going to get into emerging markets. It's good advice, well worth listening to. Available now as bonus content. It's Wednesday, the 17th of March, 2021. I'm Sean Aylmer, and that was Fear and Greed. Enjoy your day.